There's no hiding the fact that 26% of the wealth is in real estate. So you need alternative investments, and that's what Passive Investing Mastery is about.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Patrick Grimes. Patrick, how are you doing today?
I'm doing great, Todd. I mean, I think I know your partner, and I've heard of you for many years. It's finally good to connect. Finally, good to finally connect.
Yeah, I've been wanting and meaning to get you on the show for quite some time. And my partner, Drew Whitson, has been like, hey, you got to get Patrick on the show. He's an awesome guy. And so I'm like, all right, let's do it. So finally, we're here. We're connecting. I'm excited to have you on. And I know our listeners are going to get a ton of information here. So Patrick's the founder of Passive Investing Mastery, a company that's dedicated to educating and providing alternative investments to help investors diversify their portfolio. He's also the founder of the private equity firm Invest on Main Street, where he's acquired over $600 million in real estate, including over 4,000 units of multifamily in emerging markets across Texas and southeastern U.S. And you've been at Patrick, he's been active in real estate investments since 2007, involved in a lot of different things. Partnered with an Amazon #1 best-selling book, Persistence, Pivots, and the Game Changers, Turning Challenges into Opportunities. And man, we're going to dive into a lot. I just want to start a little bit with maybe your background, your story, and then I want to jump into the challenges you faced during the last Great Recession.
Yeah, sure. So, like many of your listeners, I came from a hardworking corporate America job, and I was a machine design, automation, and robotics engineer. I have bachelor's in mechanical engineering, a master's in engineering, and an MBA. And I started out right out of college as a machine designer. I got some advice early to diversify into real estate. It was actually to invest as much as you can as soon as you can. I got real eager, got my head way over my skis and did some pre-development stuff, high risk. Didn't really realize what I was doing at the time, personally guaranteed loans. Then we had essentially the global financial collapse, the prime market collapse, right? And everything dried up, developers went bankrupt, personally guaranteed, lost everything. So that was tough for me. And that was the short story behind that. Still a talented engineer, but very embarrassed and ruined real estate investor.
Yeah, that's tough. But you're sitting here still to this day. Now it's, that happened in 2000, 9-ish time, and you're sitting here today and we're on a podcast and we're going to be talking about real estate investing among other things. So you didn't quit, and you continued to say, hey, this is the right path, this is the right avenue, which quite frankly is, to me, what separates people that are successful from kind of the rest, right? And the vast majority of people would have just been like, man, that just was the worst thing to do. I'll never do that again. What made you stick with it? What made you go, okay, yeah, that sucked, but I'm going to lick my wounds and I'm going to get back up and I'm going to do it better this time?
Well, initially nothing. I wasn't planning to dive back into it, right? It took me years to recover. I financially, my emotions, my ego, and my pocketbook, right, to recover.
Yeah.
When I was back into my high tech career, I doubled down, got 2 master's degrees, started pocketing bonuses again, trying to figure out where to diversify and where to invest. And the breadcrumbs of the wealthy led me right back to real estate, but not more speculative pre-development. Existing construction, I learned about recession resilient markets, ones that have diversified employment and outperform in recessions, and how to buy for cash flow, stabilized income producing assets that I could make a moderate improvement to. And that was all residential single family. So I was basically not a flipper, but I was buying and improving and holding, renting. Still have some of those today. I haven't sold them all, but that got me back into it. I've always been a diversification guy, and if you look at any of our decks today, it talks about the diversification of the wealthy, and there's there's no hiding the fact that 26% of the wealth is in real estate. So you need alternative investments, and that's what passive investing mastery is about. So, and allocation into real estate, real ownership over real property is important.
Um, so you went from the speculative, we're gonna pre-development and you're selling and to saying, hey, we're gonna just hold cash flow. That was the main change, right?
Yeah. So I single family buy assets that I can make an improvement to was really the big,
Yeah.
and from there it worked, right? I
Yeah.
was able to, from California, locate properties and um, got built a team out there, was able to underwrite them, learn how to analyze them. The numbers made sense, pick them up from wholesalers or investors that are out there, and then had my contracting team constantly renovating and refining out and reinvesting. And so that worked really well. The problem is that it worked really well. The other problem is that it took all my time.
Yeah.
And so I was really demanding job, trying to be an active guy in single family while doing all the jobs in single family, while traveling and having a really demanding and trying to have the lifestyle that I wanted. I mean, I'm an outdoorsy guy. I whitewater rafted the Grand Canyon, hiked base camp of Everest, traveled through a couple dozen countries in the world, spent
Hmm.
2 years abroad.
That's awesome.
But doing all that at the same time was brutal. And it all came to a head when I met my soon-to-be wife, because I just realized I can't do all that stuff. I can't be a moonlight real estate, daytime engineering, and on the side do my adventure sports and still marry this girl. So something had to give. And so that's when I gave up single family, hung up the hat, and I knew that moving forward I had to do something different, and which led more towards more strategic, thinking of it more like a business. If I was going to set up shop, what was I going to do? Who would I partner with? Right? I'm not my own mechanic for my car, so why don't I partner with some people? And what's the way it can scale? Single family, just man, it was so hard to get it to scale.
Yeah.
That I traded and started a private equity firm and started taking down larger apartment buildings.
Yeah. Really hard, especially out of state. So like you're in California. Where were you investing most of your single families?
Texas and Houston.
Texas.
Mm-hmm.
Yeah. So I mean, you're sitting there in California, the only way to get there is to fly there or forever drive. But that's one of the things I started, I was investing in duplexes and single families in Milwaukee, Wisconsin, and I'm living in the Twin Cities. Well, it's a 5 hour drive or it's an expensive flight. And even that didn't make any sense because I looked at the dollars and time I had to spend just to get out there. And I'm like, man, that's a whole month of cash flow that I got to like get rid of just to travel to these properties for, it takes up like a 2 or 3 properties worth of cash flow for me to travel there. And then I got to spend some time there and then I got to travel back. And it's like, how many times can I keep on doing this to erode my cash flow? So it didn't make sense. It didn't pay the bills. And like you said, it's hard to run a true business like that without taking all of your time up. Now that has to become your new hobby. It can't be kayaking the Grand Canyon, hiking and stuff like that. It has to be your hobby has to be real estate if you're going to continue to go that route. So you decide, hey, there's got to be a better way, and you start partnering with other people. You mentioned you started a private equity firm. So what do you do, and like what kind of partnership are we talking about?
By the way, Todd, I totally resonate with that explanation you just gave. The quality of life just isn't there if you're burning the candle at both ends like that,
Yeah.
right? And the returns are there. And I'll also say the asset protection is not there because the single family just doesn't afford you the protections that larger multifamily does, right?
Yeah.
So you're risking it all too. Yeah. So my private equity for so Invest on Main Street is the name of the company that we started, and the goal there is to raise capital. I've done basically everything with my own money to that point, and I realized that I knew what I was doing. I knew how to do deals. I knew how to underwrite. I knew how to asset manage. I knew how to flip properties. I knew how to improve them. But if I was just going to take down these in the recession resilient markets, they're not $1 million homes like they are here in California. They're, 80, 100, 200, $300,000 homes, right? Unless
Yep.
you're going really high end, but that's not where I want to be. I want to be in, B class
B
assets,
class. Yeah.
So it's just so hard because each one takes the same amount of time that I started learning about syndicating. I started learning about raising capital, and that allowed us to take down bigger properties and renovating in a similar way that it is single family, but do 40 or 80 units at a time. And then I can have that one crew do a rinse and repeat, unit to unit to unit. And so ultimately, it took 2.5 years, by the way, because it was a lot. And I'm a geek that I like to learn. So I basically downloaded every course, attended a bunch of webinars, joined masterminds and educational channels on Slack, joined a team of analysts and underwriters to learn how to underwrite these deals, met with brokers. It was a long process, 2.5 years before I said, hey, honey, I'm not doing single family. And she came to me at my very last single family closing. And then for us to close on our first multifamily deal. And that was an 86 unit apartment in North Augusta. And ultimately, my engineering analyst calculus, there really was nothing in between. Once you underwrite all the deals in between, there's because until you get to
Yes.
that 80 units, you don't get a large enough loan balance where they
Yeah.
could do a non-recourse loan where the assets are valued enough to be the collateral for the loan. And you're not
Right.
betting yourself every time. They're not large enough to pay for the on-site maintenance
That's the, yeah.
and leasing,
Right.
which is what you were pointing at earlier. It's the headache of either you or a property manager driving around and how the economics of these smaller assets don't support just the time to travel between them. So they're neglected, right? And so there's just so many reasons. And then the economy of scale that you can renovate.
Yep.
It really is nothing that makes sense between 3 bedroom, 2 bath, in my mind, 3 bedroom, 2 bath, and 80 plus units. Maybe
Yep.
some markets 70, maybe some markets 60, but 80 is a pretty solid number.
Yeah, unless you're managing in-house and you got a really close eye on it. And even that, those can be difficult. And quite frankly, like I was just talking with a friend today, we've both got some properties that are, under 100 units, close to that 100 units, but under 100 units. And even those properties can be difficult because you feel like you have to. So, we've got some properties in the 90 unit range. And if you have to have a full-time maintenance person, you have to have a full-time staff person, but it's almost not big enough to need those. And the other thing is, man, I really like having two people there in the
Yeah.
office at all times because I've got some accountability. The one person, I was telling a story. I said, look, I went to this property of ours and the office was supposed to be open at 9 o'clock. I show up at 9:30. The office is still closed. Luckily, the contractors had keys to the units and we were walking units with contractors anyway. So no big deal. 10 o'clock, I go back to the office. It's not open. 10:30, finally the office was open. I think office was open at about 11. And I go in the office, talk to the office personnel for a while, and it's just one gal. And then I come back at noon and the office is shut again. And an hour and a half later, she finally is back in the office and I find out she took a nap in the parking lot from noon to
Yeah.
1:30.
Right.
But there's no accountability there.
Yeah.
And
There's
I'm
no
like, if you're doing this
accountability.
with the
Yeah.
owner there, what are you doing on every other day?
And
Right.
there's no
So
competition, right?
there's no
You can't,
competition.
because you'll see one, we've had issues where a leasing agent will just sit around most of the day on their phone, but then follow up right before the end of their shift with the leases.
Yep.
And so that there's no way there could be any response back, right? But then
Yep.
they check the box of their metric to
Check the
do the
box.
follow up, but there was no competition of any camaraderie between the two. But yeah, there's a lot of issues there, and I completely agree. And we have, like, in Atlanta, we bought two units that I think one was like 45 and one was just below 50. We're like, well, they're near each other, so we're gonna have a leasing office at one. Invariably, the one where the leasing office wasn't suffered,
Yep.
right? And
Every
you
time.
couldn't you couldn't get the relationship even between those tenants and the leasing office that are necessary to really get
Right.
in front of them to catch them when they're not paying, to get the promise to pay for them to agree. There's also that relationship aspect where you really want people there looking out for them, that they can stop by, they can complain if something's not right. And you just it develops a happier community when you have that.
Yeah, absolutely. So I want to talk about what you're doing now. You mentioned prior to the call, you're really focused on recessionary funds
Mhm.
and basically protecting investor capital. So let's talk about kind of what you're doing now with those. What's a recessionary fund? What does it look like? What are you doing there?
Yeah, well, so we grew Invest on Main Street just over 5,000 apartment units, and the in partnership in 5,000 apartment units. And throughout that course, I had my investors getting further and further indexed into real estate. But meanwhile, at the front of all my investor decks and my passive investor guide on my website, I had the diversification of the wealthy. That's 26%, right? And how else are we investing? And so we did some other things, like we did energy investments, and people were like, well, how does that make sense? This is a real estate company. I'm like, well, let's start a company, Passive Investing Mastery, that then is more in alignment with our investment thesis as an organization. And I can then be more forward facing and reflect on how to allocate like the wealthy. And so that's why right now we have graphs that show here's the Tiger 21 ultra wealthy allocation chart, fixed income, and how do you invest not just in real estate, but how do you in common equity, you buy things, but then how you invest in debt right now, which is high interest rate and high demand, where you get really high outsized, lower risk cash flow. And then how do you invest in things like energy or even litigation funds? And so we really have passive investing masteries providing this opportunity for people to come and for us to show my cards. We just had a webinar on gold investing, gold and silver investing with the American Gold Exchange president, and strategic metals investing, how you can get 20, 30% on gallium and strategic metals that are being dialed back by China. So there's a little more holistic approach to a balanced portfolio. And what's really cool about today is this is the second best buying opportunity in my life. I think I told you on the first buying opportunity, I was getting raked over the coals real bad because I got way too indexed. I was way too eager. I was speculative, and I was personally guaranteed on pre-development real estate, and I got ruined in 2009 and 10. But now, today, it's an incredible time. We are able to buy commercial assets. We don't do office, right? But we're buying small balance type, more than just multifamily, even
Yep.
some industrial, retail. But it's such low basis, all in cash, that we're getting on the buy returns that we'd usually have to renovate and hold for 3 to 5 years for. And so we call that the recessionary acquisitions fund. So it's not a fund where we're buying and slowly renovating over time and hoping that rents grow, which they haven't. They've slid horizontally or sideways. We're not hoping for rent growth because we've injected capital, and we're not hoping that rent is high enough to afford the capital, which hasn't been happening. We're actually buying, make the return on the buy by coming in all cash quickly, and then we're immediately selling 12, 14 months, and we're trading into more assets. And so the recessionary acquisitions fund comes in cash heavy, beats out, gets great buys, and trades forward very quickly. And we're going to buy as many times as we can in the short window when there's $1.5 trillion in commercial real estate debt coming due. A bunch of performing assets. These are not distressed assets. These are performing buildings, but financially distressed operators, right? And so we're pouncing on that. And that's why we call it the recessionary acquisitions fund, because as you may look at the overall market, like, oh, we're not in a recession. Well, in commercial real estate, this is a wild, wild recessionary buying time. And so that's buying. But then also we have the income fund. Why? Because most income's dried up elsewhere. The rise in interest rates, insurance costs, tax, inflation of payroll, all these things have shrunken the cash flow that is in typical deals where you're buying them and you're the equity owner. But for all those reasons, the interest rates have gone up, would mean the debt is more profitable than it used to be. And becoming a debt investor is now highly attractive. In fact, with the banks pulling away because they're having liquidity issues with the bond problems, and they're over indexed in real estate that's troubled. There's a huge demand for private debt, just like there was in 2011 and 12. And right now, loans that used to be 6 or 8% were originating for 13. It's
What
amazing.
what kind of loans? Like what type of what's the type of debt product? What are we talking about? Like you're doing are you doing debt on real estate? Is it distressed real estate? Like what kind of debt are you guys taking over or putting out there, I guess?
Originating, yeah.
Yeah.
So the debt fund is a diversified portfolio of debt products. So you invest in it and you're diversified. And our buy box has been 40 to 65% loan to value. And we're currently trending about 58. We do what we call small balance commercial real estate. We don't do any residential real estate. And the reason why that is because residential, it's a saturated market.
Is that because of all the like the hard money lenders
Well,
that are out there?
it's saturated. So they're doing all
Yeah.
this, yeah, risky stuff. They're not lending on loan to current value,
Yeah.
right? Where currently it's valued performing asset, right? They're loaning on loan to future value.
Future.
Future value meaning repaired value, like I used to
Yeah.
do when I was getting a loan on my improvements, or construction loans, which are loans on completed value.
Yeah.
They're making a big bet on the operator. They're making a big bet on the economy. They're speculating that they'll get to the end of that. So we're lending.
So instead of being able to get into something like that at a 60 or 58% LTV, like you said, it's it might be 58%, but that's future LTV, assuming everything goes perfectly and the market continues to go up. But maybe today it's 85% LTV at today.
Like the total leverage on like they'll do something like 90% after completed value or 90% after repaired value.
Yeah.
Meaning that they may be lending with collateral that's a couple $100,000. They may be lending 400 or 500 grand on it. So that it's literally upside down, right?
Wow.
On day one, and they're hoping to get to the end. That's how I lost everything in 2009 and 10, Todd.
Yep.
Because I was way over indexed, right?
Yep.
And over leveraged it upside down. And so small balance commercial real estate, we're able to lend right in that sweet spot, around 50% loan to value on current, not distressed properties, financially distressed owners. So cash flowing assets. We have high debt service coverage ratio requirements that allow them to pay the loan. So it's really interesting because we're able to come in, only lend on properties that currently can pay the debt service, right? And get a high interest rate, which again, is almost double what it would be just a couple of years ago, but for the same assets.
Why is that? Why is that company not, are they coming to you and not just taking out a loan with a lender, with a bank, with somebody that's, because you're charging much more than the, let's call it 7% that the bank might charge.
Well, so they used to charge 6-7%, with rising interest rates. Now the lowest I've seen is like 8-9%. But even in those, I don't know if you've tried to get a commercial loan recently, but this small balance commercial real estate loans are extremely hard to get. The regional banks that lent on them previously are the ones that are over indexed in non-performing loans. They got too greedy. They lent on too high a LTV, and they did too many of these after repaired value or construction loan completed value. Meanwhile, repair costs have gone up, interest rates have gone up, insurance have gone up, and a lot of these are distressed. So there's like some 64 billion in distressed commercial real estate debt right now, right?
Yeah.
So a lot of these lenders are pencils down. If they're not pencils down, they're moving at a snail's pace. And we did, one of my partners tried to get a loan on an asset. They're like, we'll close in 30 days. At 60 days, they had retraded them twice. And at 90 days, it got to all the way to the president before he said, sorry, no dice. So if you really want to get the ability as an investor to take the opportunity to buy right now, when you can buy at extremely low basis points, or you're an owner and operator and you need to, your debt's coming due, you've got to do something, and you're willing to refinance and reset a basis that's reasonable, but you don't want to lose the asset, we can provide you with a gap transactional or bridge loan that'll allow you to either acquire the asset or an asset, if you own it, pull some money out in order to improve it or keep it afloat. If you don't want to keep it, we'll buy it in cash in the acquisitions fund, right? And so it provides the solution to performing assets owned by financially distressed operators. It just didn't quite set that ship a sail in the right way, and they've been taken on water and they're about to sink. And we'll give them a lifeline to hang on to it through debt, or we'll take it off their hands through an acquisition. And so it really provides that solution that I think the market really needs, and it has to come from private equity because the banks are not liquid enough to do it.
Yep.
And the operators need a way out. And it's been great. In fact, we're on the uptrend right now. We're seeing more leads than we did all of last year. We're seeing just in the last couple months this year. So it's just incredible opportunity to jump on this bandwagon. Again, it's the repeat of the path. This is exactly what happened after 2009 and 10. I was just getting raked over the coals. Yeah. And right now we're positioning to win big from it. So that's the debt side, the income fund.
Oh, wait, I got one more. I got a question
Okay.
on the cash.
Yeah.
Okay. So you're buying all cash. You're buying low, selling quickly. Oh, what kind of commercial? You said commercial, but like, are these multifamily? Are these office, retail, industrial? Like what kind of properties are they?
So we have sworn off office and we put it in our doc. So nobody can force us to do office.
So
right?
not office.
Great deal. I'm just not an office fan. Never been. You know, I've been a remote worker for way too long. I'm not a believer in office right now. And although there's a sliver of office where you can repurpose some of it to multifamily, that's like 3%, and somebody else is going to make a lot of money doing that.
Yeah.
Not me, right?
Not you.
Yeah. So, but yeah, so no office, but we have mostly industrial, some smaller multifamily, and retail. And those are 3 assets right now, which are specifically getting pulled away or walked away from by lenders, not because of the risk profile, but because of the liquidity issues. They just simply, it doesn't really attract some of the bigger banks. It's the small regional banks that do these kinds of loans. And if we can reset that value, maybe they got to take a haircut, right? I don't have any more hair to cut off, but maybe they got to take a haircut. And if we can reset that value at a loan to value, that gets us a lot of protection from the volatility above, right? We're at a 50% loan to value. Market has dropped 10, 20, or 30% in some areas, right?
Yep. Yeah.
We're resetting that now at that. I mean, we have a lot of padding between the market volatility and these assets.
Yep.
And much of them that we're originating on, like one of them, we did a 50% LTV on, 13% plus 2 points. It was purchased at a 10 cap, meaning, man, they're cash flowing like crazy, but that's only at 60% occupancy. So they're going to occupy it up to 40%. And it's going to be cash flow like 15, 20. It's insane. Like these assets are profitable, performing assets. They just need new operators. They need to have the financials reset.
Are you buying these then? So you're getting them from banks a lot of times?
No, we're getting the leads from direct to owner outreach.
Direct to owners.
Yeah.
Okay. And why not hold these properties?
Well, that's just funny because it's funny you say that because there's a lot of investments where you can always put money away for 3 to 5, 6 years, right? But if you do that now, today, you're going to miss this entire buying cycle. Like it is the second best. I mean, no, it's undisputed the second best in my lifetime. I don't know how old you are if you go further back, but a buying cycle. I want to take investors' money and mine, and I want to buy as many times as we can. Wow, we can do this because we can. This is why we call it the Recessionary Acquisitions Fund. Because we couldn't do this 3 years ago. We had to buy a property, infuse tons of money into it to renovate it, and hold it and slowly improve over 5 years to get the same returns we can on the buy. Now, sure, we can squeeze it and go from, slivers of greater returns over the next 5 years. But in our investor deck, we show our case studies. The case studies demonstrate that the diminishing return of holding and the improvement is not worth it when you know you can trade forward and gain another 10, 20, 30% in equity by doing an exchange forward. And why the acquisitions fund is wholly unique from any other fund that I have ever seen. It's that when an investor invests, we buy a property and we sell it or we refi it, those proceeds don't get distributed to the investors. The refi proceeds go to buy another asset. The sell proceeds go in an exchange to another asset. And the first asset becomes two, and two becomes four. Now we distribute revenue in the form of revenue from the form of rents to our investors, but we compound your growth and step it up as fast as we can, as long as we can underwrite in this way. And my calculus of crystal ball, how much I can make on the buy, is super clear. But once I get past a year, what's going to happen? It's not so clear anymore, right? And so that's why that strategy is very unique and specific to this recessionary time.
Yeah. So I mean, the idea, right, is you're going to buy this first building for, let's just call it $1 million, right? And then you're going to sell that, and then you're going to buy the next one for 1.8, and then 3.2, and then continue on. And so within 3, 4, 5 years, instead of having that $1 million building, that same investor group has a $6 million building, or call it what it is, but you're going to just continue to do that. And you're going to 1031 as you go.
Well, so the first asset we bought was about 4 million, and we did it all in cash. We immediately refied out 2 million. We bought the third asset, which we actually bought at 900K, but the prior owner had bought it for 1.8 million. I mean, it was just an incredible buy going in. The first asset appreciated immediately after we bought it for 5 million. It appraised for 5 million immediately after we bought it. And we're going to put it out on the market in May, and we're likely going to pull 3 more million out of it. So again, that one was cash flowing, but very low occupancy. We don't have to really put any capital into it to make the return, because we bought it at 4 million and appraised at 5, and there were other people that had offers on it for higher amounts, but they weren't doing cash buys. We essentially made 25% return just on the buy, right?
Quick,
and then we
close.
buy another asset just on the buy. So we got 2 assets from one. Now we're buying a third asset. We likely won't need any capital in addition to what we already have in the fund for that. But if we do, we'll infuse just enough in a tranche, right, from LPs. And then we'll have 3 assets from one, plus maybe some additional capital. And then we'll continue to compound so that we buy as many properties as we can and increase the diversification. So it really is 1 to 2, 2 to 4, 4 to 8.
Yep. That's awesome. That's awesome. Okay. So we got the cash fund, the income fund, and then you have 1 more or 2 more?
1 more fund?
You have,
So we have, if you're looking for cash flow, the income fund, right? Anywhere from 7 to 15%, depending upon your lockup period. Appreciation on the acquisitions fund, right? That's pretty high appreciation. There's some income there. Doesn't start high, it goes bigger later as we compound, but there is high appreciation at plus 20, 30%. I mean, we're seeing it right now. It's incredible. But kind of those are, it's interesting because the debt's really low on the capital stack, low risk, 58% loan to value across the portfolio. We're doing really good on the make the return on the buy and the acquisitions, but those are both in that same sort of real estate space. And so we value being completely non-correlated to, and so we just had, like I mentioned, we had a webinar about metals investing. Well, this next fund we're launching is a very exciting one. And I've actually been chasing an opportunity to participate in this for 5 to 6 years now. It's been a long time. And my partner in this has spent 15 years putting together these kinds of investments for sovereign nations, large hedge funds, qualified purchasers, private equity. So it's just like the who's who in big money, but it's only been 100 to half a billion, 100 million to half a billion funds. And he and I have been talking for years about, hey, let's create one of these funds that gives this completely alternative investment, non-correlated to anything else, not correlated to real estate, not correlated to gold, not correlated to the stock market. It's completely alternative, which would help to balance the portfolio and where the wealthy
Yeah.
do it, right?
Yeah.
Let's make it available to accredited investors. And the play is in litigation financing. Now, litigation financing sounds complex, but it's really not, right? Litigation financing means there are what are called mass torts. There's a bunch of there's a bunch of lawsuits that have happened for very valid reasons. We don't do frivolous lawsuits. Not like, hey, I burnt my coffee at McDonald's, right? That's not what we're doing. But there are things like the foam bombs that were used by the military and firefighters, foam bombs. And 3M is one of the companies, right, that produced those. They failed to disclose the health risks, and those are causing cancer to firefighters right now and firemen. And these have been trials have been going on by some of the top law firms in the country, and it is known exactly what somebody's entitled to. However, these disadvantaged heroes of our world don't have the money. It ruined their lives, literally. They don't have the money to. So we help put up the funds to find and fund the litigation, the David and Goliath, right? To fund the litigation costs for them to take their claim. And depending upon the type of claim, which there are several others, we take a split. We take 40%, we share it between the attorneys, and we get to help these people get part of what's owed to them where they otherwise wouldn't be able to, right? And it's not just the foam, there's hair relaxants, people that put hair chemicals. And it was known that there were damages to those. There's large farming companies, I'm not going to name the name, but that produce Roundup. It was known to them of the health consequences, proven known to them the health consequences to these. And now farm workers that didn't have proper gear are now having cancer and cerebral palsy and all kinds of issues. And so there are lots of the hardest working people in the country that don't have the ability to go after the Goliath, that need somebody to help support them. And as a result, I predict we're going to start seeing these large companies change their calculus, change their risk calculus, begin to understand that we're leveling the playing field. Litigation finance is leveling the playing field. Now, I'm not an ambulance chaser. We don't do that kind of stuff. But the ones we're selecting are very qualified companies that have the ability to pay out. They deserve to pay out, right? And reachable claimants, people that need the money and that we know we can reach, and it's been calculated and proven. And so it's so secure, in fact, that you can get insurance on it. You can literally buy a hedge. Once we package, here's all the claims we're going after. AAA insurers will insure those, just like they insure real estate. Wow. So if the building burns down, you can rebuild it. If for some reason the judicial process of the United States falls apart, which is really all this is hedged on, it's still insured, right? Like imagine the day when there's a financial collapse, but imagine the day when there's a complete collapse of the judicial system. like that's the downside to this. Or but there's still insurance we can get. So it's a real tangible asset, 2.5 to 3.5 years out. We can put the capital to work right away. It's in a diversified portfolio of these kinds of claims. And there's some in there that are really cool, like sexual survivor, organizations that allowed and knew that abuse was happening, right? And helping those people. There's a lot of really cool stuff in there, but at the end of the day, the claimants get over 50% or over of the claims that come back to them. And we're putting up a few grand to get them 100 grand, right? Whatever it is that their element is due, which has been determined. And it's 2.5 to 3.5 years, and it produces returns that are above 20% IRR, right? It's just, and with the downside protection that's in there, it's a no-brainer.
That's cool. That's cool. All right. I have so many more questions for you. This is fascinating stuff, but we do need to wrap up. But I'm gonna have to have you back on, because I want to talk a lot about the business side and how you've grown and marketed and all that kind of stuff. But for sake of your time and my audience's time, I gotta ask a couple last questions. So what's a mistake that you've made and and yeah, I guess we already talked about one, but what's a mistake that you've made and how have you learned from it?
What was the one we talked about? Oh, when I got too eager too quick
Yeah,
and
yeah, yeah,
yeah, and I got heavily indexed in pre-development. I was speculating. I learned how to be the tortoise, not the hare after that.
yeah.
Um, that was the biggest mistake I made after that was sacrificing time with my family, friends, and hobbies
Hmm.
to try and keep a hard job career going without partnering, without trusting, without learning how to partner,
Hmm.
and without trusting in others. That was the hardest thing,
Yeah,
because it wasn't until much later that I was willing to give up some control over my own money. I was willing to, level up my game to be able to scale in a way where it better served my family, better served my investors, and we were able to produce, better returns. So that was probably it.
did you find that once you gave that up, you actually started making more money as well?
Oh yeah. So I mean, it was my wife and I, we got to the point where I was a contractor doing automation and robotics, and we were able to do stuff like move to Hawaii during COVID. My wife just came out one day and was like, "Hey, talking to some people at work, I think we should move to Hawaii." 2.5 weeks later, I had us packed up and on a plane. Right, the ability to do that was because we had this safety net that, and I wasn't working around the clock all the time. I wasn't burning the candle at both ends, and
Yep.
I was able to invest in a better quality of life for the family and be opportunistic about times in which people were allowed to work from home, like my
Yeah.
wife.
Love it. Patrick, what's a favorite book you can recommend to our listeners?
Apart from mine.
Yeah, apart from yours.
Apart from mine. Yeah. So, um, the CEO does these three things by Trey Taylor. He's a good friend of mine. Really like that guy. He just produced this book, and I told him so I run around the lake behind me in the mornings, and I listen to podcasts, I listen to audiobooks, and I listen to self-help and leadership books. And I told Trey, he's such a great guy. He's family office investor. He's got a really incredible business, and the book is so filled with stories and very cerebral conversations about what a CEO does. And I told him I typically listen to books at 1.5. I slowed it down to 1.25, and then then I slowed it down to one. And I told him that's the best compliment I can I can ever give somebody. So because I think pretty quick. But anyways, yeah. So this guy, CEO, does these three things by Trey Taylor.
Nice. But I have not heard of that one, so I'll have to pick that one up. Uh, Three pillars of wealth creation.
Okay, so I mean, I'm sure I could come up with a much more longer, calculated version of this, and my passive investor guide on our website has all kinds of stuff in there. But I really look at financial freedom really being that first step that gets you out of scarcity. And so a lot of these mechanisms that we talk about investing are about getting free of the control of your day job, getting more financial security, but it's about getting you out of scarcity and fear. And and of course, we have this theory of diversified investments for that, right? But it really, in our mission at the Passive Investing Mastery, is to get, that's just the first step. Second step is to allow you to be able to have the resources to spend time with your family, your friends, your hobbies, and to invest in the causes you care about most. So financial freedom really is a resource driver. The time freedom is what gives you that ability. Then I think would be the second pillar, that ability then to spend the time. That really is the currency that you're wanting to create in your life. And while I was creating a lot of wealth in single family and my engineering career, I didn't have true wealth, which was time freedom and the ability to then spend that. And I'll say I'll probably make the third one location freedom, because when we were in COVID, we were in LA, beautiful little home, became a trap. It's not only was COVID, but there were fires, and there was all these fires happening
Yeah.
that year.
Yeah, that's
We
right.
had industrial filters going on inside the house, and every time we opened the car door, it was just filled full of ash. And then we were on quarantine, but then we were on curfew because of the the demonstrations going on, like
Yeah.
all the buildings boarded up, cute
Yeah.
little town, little village we were in, and it became like a war zone. The ability to have location freedom meant we could uproot ourselves, and in 2 weeks, in like one day, we woke up in Lanikai on Oahu looking out over the Moku Islands with the sunrise. And there was just something that
Amazing.
made that magical. And my wife was
Yeah.
crying for a different reason, right? She was tearing up because, but yeah, so it was, that's probably the third one, is to get you there. And then to be able to, location freedom also, I've traveled to 24 countries, and it was through kind of the spiritual journeys I did. I flew to Cairo during Ramadan, traveled down the Nile to Sudan, climbed Mount Sinai and Sinai Peninsula, went through Israel, China, and climbed up sacred mountains, stayed at Buddhist temples. I spent a year doing that.
That's cool.
And I did the same thing. I did that a couple of times. And I think until you actually kind of immerse yourself into some of these other cultures and start kind of participating and just getting kind of a clue of how other people live, it can really change your outlook on how fortunate we are and how limited we are by the beliefs here. And I think that location freedom can also look like the ability to really grow and expand your understanding of the world and how you can live by being in these places instead of just reading about them or going to a yoga session.
Yeah, that's awesome. Love it. Love it. Man, Patrick, a lot of good stuff. Really appreciate you joining me on the show. And I got to get you back on here. We'll dive in more. I mean, there's a lot more to talk about that we haven't even touched. So appreciate it. Appreciate the time. And you have a fantastic rest of the day. Oh, wait, how can our listeners get in touch with you?
Oh, so I do get to talk about my book.
Yeah.
Right?
Yeah.
So passiveinvestingmastery.com, all spelled out. I know it's long, but passiveinvestingmastery.com, all spelled out. If you go to that website and then type in /book, or there's a link on the homepage, I think, passiveinvestingmastery.com/book. I do have a book. I loved it. It's persistence, pivots, and game changers, turning challenges and opportunities. I'm on here with hair, so I did have some proof there before it.
You used to have it.
Yeah, and then I co-authored this with some other people. Phil Collins, lead guitarist of Def Leppard, an actual rock star, super fun. There's Russell Gray, some NFL, NBA players, entrepreneurs, actors. It was just the most fun book. I was so excited to be a part of it. Made an Amazon bestseller.
That's cool.
I give it away for free. It's kind of like my give back. I actually sign it too. So if you go to there, type in the name of the podcast in the promo code. That's the secret page, investonmainstreet.com. Sorry, passiveinvestingmastery.com/book. And in the promo code, just type in the name of the podcast. We don't give it away. I don't ship it to everybody random. But so as long as we know where you came from, I'll sign it. We give it away. I hope it inspires you on your journey. And on that website, Passive Investing Mastery, you can also just set up a meeting with me. Part of what I love to do in this world, and this, when I've been able to walk away from engineering and do this full time, is I get to connect with people like Todd, other real estate investors, and I like the impact that I get to have on limited partners and passive investors and hardworking people that are just trying to make the right decisions with their retirement. So wherever you're at, happy to chat with you, understand your goals, get you pointed in the right direction.
Awesome. Again, Patrick, really appreciate it. And listeners, reach out. That's an awesome free gift. So take advantage of that.
Thanks, Todd. I'm looking forward to coming back.
Take care. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com,
and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.